Three important topics today. One, rates. Two, buyers, tips and tricks that are really going to help you convert more buyers. And three is some tips on VA. Hello, my name is Mike Florin, and I'm the owner of Low Cost Mortgage. Today is your weekly update for June 4th, 2025. This year's going fast already. I got a notepad right here, so I'm going to look at notes that I jotted down from earlier today when I was doing some research. We're going to look at the history of interest rates here for a bit, kind of preface what we're about to talk about. We're going to go to a 5-year history over here on my left, and that 5-year history is showing the highs marked in a circle of where rates peaked and then they came back down again. Now, typically rates, they go up quickly, but they come down slowly. And that's usually what we expect to see. But I want you to look at these circles. The highest interest rates ever were in the last 25, 30 years or so is October of 23, and it's circled right there. Over on my other shoulder now is 1 year of that data, and I've circled the highs that we've seen where the rates come up and then they come right back down again. It's a peak and then it comes back down. And that peak is July and December of 24, and then you have January, April, and May of 25. But if you look at the one in April, it kind of goes up sharply and back down again. You look at May, which was just a few weeks ago, it was up for a week, but it peaked and then came back down again. So let's pull into the 3-month chart. The 3-month chart is showing that rates are returning back to that range. In fact, here you go, here's some lines, and now you can see where the range was in that downward movement. Last Friday, it actually touched the high end of that range, and then we moved into that range a little bit more today. Rates got, significantly better today, which is good. But what I want you to see is we are on the higher end of that range, but before, just a few weeks ago, or about a month and a half, 2 months ago, it was bouncing within a range. When it would go high above it, it'd come back down to it. And when it would go low below it, it would come right back into that range. So that's what a lot of us are expecting. Those rates, it went high in the last few weeks above that range, and then it's coming back to that range. We don't expect it to go below that range anytime soon. But that downward movement you're seeing is from jobs reports, and another one's coming out tomorrow. So if rates do get substantially better on Friday, then I'll just post another email with rates. But for now, what you're seeing is a regression back to the mean, is what we like to call it. And that is where everything just kind of moves back to the average, back to that range, and it sits there. So right now it's on the higher end. Well, when it's on the higher end, what do we do with investors? Well, we tend not to put loans with investors that do not float down. We tend to only put loans with investors that do float down when we're on that top end of that range. But when we're at the bottom end of that range, which we're not there now, but when we are on the bottom, then we tend to favor investors that are just plain the cheapest, regardless of floating down or not. So right now, investors we're picking, and most other brokers and lenders are picking, are the investors that do float down. Rates. Okay. Rates are downward trending for the last 2 weeks. And if you know, we're still on the higher end of that range. Yet government loans, VA and FHA, par, which is no points or discounts or anything, you're right at about 6% or so at the rate, roughly, right at 6 or so. And then with 1 point of discount, you're in the middle highish 5s. So we just locked a few loans right at the 5.7, and we're looking at locking one at 5.6 right now. There's a little bit of discount on that, but at the same time, it's still 5s. Check your email, you're going to see the APR numbers and the exact rates there. Now, at the same time, let's look at conventional. On conventional, we're looking at mid-6s, and with a little bit of money, you get into the low 6s. So again, VA FHA, the government loans, you're looking at right around 6/ really, really low 6s, and with 1 point, you're into the middle highish 5s. But you're not quite middle 5s yet. I wouldn't call it there. It's too much money to get down there, so it's not worth it. So let's get into that transition of buyer's market. I want to show you a picture here, and this graph illustrates before the pandemic, and that is, it's kind of balanced. There's about the rough number of the same anticipated buyers as there are sellers or homes being sold. And when you look at that, it's kind of downward trending, okay? Now that means that overall there's less buyers on the market and overall there's less sellers on the market, but you can see it kind of pushing down. And then you see buyers skyrocket. Whew. Anyways, buyers skyrocket. There's a lot more buyers. Why? Well, this is during the pandemic. This is 2020 to 2022. Rates were the lowest. We have seen them in our lifetimes. You're looking at government was in the low twos, conventional was in the low twos, everybody was in the low twos at that time. So when the interest rates are low, some people are going to go buy 2, 3, or 4 houses. Some people are saying, ooh, it's such a good deal, I'm going to go buy anyways. So you had so many buyers enter the market. Well, at that point in time, if there's more buyers than there are sellers, everybody knows this, it's a seller's market. The sellers can be picky and choosy as to which buyers you have, and you have bidding wars and everything else. Well, now we've transitioned to the buyer's market. Now we've transitioned to a buyer's market. And in the buyer's market, there's more sellers than there are buyers. That means that the buyers can be more choosy or choosier. Sellers have to do more to sell their homes. During the pandemic, when it was a seller's market, I saw a bunch of listings where realtors were literally snapping pictures with their cell phone, posting up some really blurry images, and the house sold within a day with multiple offers. Why? Because at that time, the interest rates were in the 2s. They will never be there again. So there was a lot of buyers because the interest rates were in the 2s. So now we're looking at a buyer's market. Interest rates are in the very low 6s, high 5s, somewhere in that general range. Now, twice in this last year, rates for us dipped into the 4s. They dipped into the high 4s. That means that rate refinances are very high in probability. Okay, so that transitioned us into tips and tricks to work with buyers, to get them off the fence, to get them buying a house. Bits of information that are kind of helpful. Okay, we're going to go to bullet point 1. Bullet point 1 is negotiation. Right now, buyers can negotiate things that they could not negotiate before. In the last year, year and a half or so, we have seen a lot of seller credits. A lot of seller credits to pay for closing costs, prepaids, 2-1 buy downs. We've seen a lot of that. And we've seen a big growth of 2-1 buy downs, of 1-0 buy downs, and a handful of 3-2-1 buy downs, depending on how much money there is. So with that being said, the buyers can negotiate for the closing cost money much easier now than before. In fact, we're seeing just about every deal, not every deal, but just about every deal has seller credits. The next big thing, rates. When you're doing your long-term rate planning, when you're talking to a buyer, okay, they need to understand where rates will most likely settle to sometime in the future. Now, this could be 2 or so years from now. It could be 3 or 4, but we're going to look at what interest rates were before the pandemic. Before the pandemic, government, VA and FHA, 4.25. That's what you want to plan on your future planning for future budgets. If you use 4.25, you should be fine. You could use 4.5 if you wanted to. But if you want to look at a borrower and they're buying now and they're saying, ooh, it's a little bit high, what could my payment be? What we are is we're doing 2 basic numbers for them. We're doing one right in the low 5s, and we're doing one right in the low 4s, right at 4.25. Not 4.1, not 4.0. But we did a lot of loans at 4.25 for government before the pandemic started. Now, conventional, same basic thing. Conventional right now is mid 6s for decent credit, enough down, etc. Maybe low 6s if they buy it down a little bit. But now, future planning. What was it before the pandemic? It was high 4s, right around 4.7 or so. Same basic rule applies. If they are going to keep the home for many years, then they need to look at what am I most likely going to refinance to? And I'm not saying it's absolutely going to go there, but before the pandemic, it was right around 4.7, 4.8, depending on your credit score. That's really what it was. So if you do your long-term planning, then you're going to look at where were rates before, what would my payment be if rates were there later in the future, and with some buyers that have the budget, getting them off the fence to buy a home, that might be a good persuasive argument as long as it makes sense to them. So that's something that you can bring up. We can work numbers for them. You could even do some basic numbers for them if you want to. Why? Because there's mortgage calculators all over the internet. You could do the same thing. So those are kind of those big pieces for tips for buyers, at least when it comes to the mortgage side. And that is tip number 1, Sellers are paying for things. They're giving you seller credits. Tip number 2, long-term interest rate planning. Plan on doing 1 or 2 refinances in the future. One, government to get you down into the low 5s. The second one, low 4s. Maybe we can do one to get you down into the 4s when it's that point in time. Conventional, you're at mid-ish 6s right now. Well, you're going to do one in the mid-ish or lowish 5s or so, but one in the highish 4s or so. So again, you're going to plan on 2 or maybe even 1 refinance. Those are good points for buyers, basically. There's more, but I don't want to make this video too long. Now, VA. Okay, my bread and butter is VA. I'm a veteran. I own the company. I do a lot of VA loans. With that being said, is it possible for somebody to get a VA loan when their debt-to-income ratio is in the high 60s? Yes, it is. Still is. We're working on one right now. We just saved a veteran $26,000 and we were lower in interest rate. Both. Now, how do we do it? It's simple. That's the way this company's set up. Good, fast, cheap. We don't just say cheap, we are cheap. Now, that being said, this particular buyer, his FICO score was in the high 7s. Well, when he's in the high 7s, he can do things that are interesting. For example, debt to income wise, usually you're limited to in the 40s somewhere if you have low credit on VA. So in the 40s somewhere for debt to income. And the back end can be kind of about 50. And that's if you have like a 640 FICO score, kind of low 6s, somewhere in there. Well, if you have a high 7 FICO, you're not limited to 40 and 50. You're up in the high 60s and high 60s. So we have full approval on this guy's loan, and his debt to income is in the high 60s. So is it possible to be up there? It absolutely is. The highest debt to income I've ever closed was in the middle 70s. The middle 70s. Now, there was extenuating circumstances on that one. For example, there's income they had that we couldn't count. Therefore, I knew there was extra money in that loan, so it was okay to do that loan. In fact, they owned that house for several years and they sold it. So it was a good buy for them. They made some money on it. But with that being said, with VA, there's a big difference. When you have your VA buyers, there's a big difference between a high credit VA and a low credit VA. If they have high credit and decent stable income, you can do a lot. High debt to income, lower interest rates. Like right now, you'd be in the high 5s right now today. Lower interest rates. Versus anybody who's in the lower 600 FICO range, they're going to have higher interest rates and they have lower debt to income thresholds. So they can inherently afford less of a home for the same payment. Why? Because the interest rates are slightly higher. But also they can afford a lower home because the debt to income numbers caps are much lower. So what do? We save that guy a lot of money. Great. There's another one. All right, so we're solidly in a buyer's market. We just saved another veteran buyer a lot of money. Rates should be kind of on the downward pressure side as long as somebody in the federal government doesn't make a decision that creates instability that puts up pressure on rates. As long as that doesn't happen, then rates should be downward trending for the most part. Anyways, my name is Mike Florin. Have a great day. Go out there and sell. Oh, I'm expecting rates to probably drop again tomorrow or Friday, and if that happens, I'll just send a second email out, okay? Anyways, have a great day. I'll talk to you later.